Hello and welcome to another of these YouTube tutorials explaining how to do these financial ratios. Today, this one is obviously focused on the profitability ratios, and there are three in total. We've got the return on owner's equity, we have the gross profit ratio, and we have the net profit ratio. It's important that you know that these three ratios or formulas fit within the category of profitability. Students have been asked in the past just simply to name the three profitability ratios. Also, sometimes you could be asked just to calculate one of the profitability ratios. So you need to know which of the three ratios you should be talking about. But in this particular tutorial, we're just focusing on return on owner's equity. Alright, so what is the actual formula? If it's return on owner's equity, we want to know what the return is, that's the net profit, that's what we're getting back, and on owner's equity, and that's so the total equity. The answer is expressed as a percentage. So let's run through a really quick example. So let's imagine that the business has $103,000 worth of net profit, which is not too bad. But to get that profit, the owner has had to contribute $1 million of their own cash. So we'll divide that net profit by the total equity, and that gives us 0.103, which we should know is 10.3%. So what's important to keep in mind here is businesses is all about opportunity. You've decided to invest this, in this case, $1 million in this business, in this opportunity, and the whole point is to try and pull money back out of that investment or that opportunity. In this case, the owner is pulling back $103,000, which represents a 10% improvement. They're now 10% richer than they were last year. That's a good result. You need to rate this in terms of other forms of investment. If you put cash in the bank will pay you around 2 or 3% per annum. So clearly we're better off here. If you invested in a high risk share strategy, you may get 30% per annum, but you're following it's very risky. You could lose all of that. So it's that sort of thing. So 10% is a very respectable return. Okay, quickly, we've covered this already, but very quickly to remind you, in order to answer these questions properly, you have to run the calculation, you have to run a comparison, is the number healthy or sick, and then you need to make a recommendation for the business. Okay, return on owner's equity. We'll move through this nice and quickly. 10% is a good result. More than 20% is an excellent outcome. If the result is too low, what an owner could do is they could adjust their prices to try and improve that net profit. They could bring down their expenses, which will try and bring up their net profit also. More effective marketing strategies could be a way of doing it, because it would increase sales, depending on how much the marketing strategy costs, of course, but yeah. The only tricky thing you need to really know here also is that to calculate this, you're looking on the balance sheet for the owner's equity, and you need to look on the revenue statement for the net profit. So you're looking at the two different sheets simultaneously. Okay, so here are the two different sheets, and again we're using Capti's Crumpets. So let's go. Oops, sorry. Oh, it doesn't matter. It's up there already. So in 2004, the net profit, so we come down here, operating profit after tax, that's our net profit, was 106,440. And now we need to divide that by the total equity. So we have to come over to the owner's equity. Here's all the equity. We have the capital, the retained profits, net profits. Here's the total. So we're going to divide that by 626,440, which equals 0.169, which we should know is 16.9%. So compare it. Is that healthy or sick? Clearly that's pretty healthy. So we would say this is a good position for the business to be in. Businesses with less than 10% return owner's equity would be a problem. Okay, let's move on. It's your turn now. So I'll ask you to press pause. Calculate it, please. Okay, so clearly, obviously, our net profit's over here, so $94,710, and we're dividing by our owner's equity. So we've contributed $1,144,710, and that equals 0.82, which is 8.2%. Is this healthy or sick? It has a slight problem. 10% is acceptable. The business needs to increase profit through increasing sales or reducing expenses. Okay. Lastly, your turn. This is the balance sheet for Holmes Hammers. Press pause. Do it yourself, please. Okay, let's have a look here. So our owner's equity, our net profit was 440,000, and we're dividing that by our owner's equity over here, 1 million or 1.2 million. Okay, and then that equals 0.83. That's 8.3%. The business has a problem. This is 10% is acceptable, blah, blah, blah. Okay, pretty straightforward. Okay, if you like the videos, subscribe to the channel, leave a comment if you like, and thumb the video, please.